So in structuring equity to employees or consultants with a company, it's something that is important to focus on and very important from a tax perspective as well. Very early on in a company's life, generally the best and most efficient way to issue equity to employees, founders, consultants, people involved early is through restricted stock. Basically they own the stock outright. They do have to pay the fair market value of that stock, whether in cash or for performance of services often as well. And that's something that if the company's very early and has not really raised any outside financing yet, you can generally attribute a pretty low value to the stock and get restricted stock into people's hands, which they own, they'll get capital gains. Once this company gets to a certain point where the common stock has to be given a certain minimum value, stock options becomes the most efficient way and effective way to get equity into people's hands. Very common. There's incentive stock option rules that govern this for employees. Can also be done for consultants under what's called the non-qualified option. For limited liability companies rather than corporations, there's sort of the good and the bad that there's a lot more flexibility in how employee equity can get structured, and there's some tax efficient ways to do it, although it also gets a lot more complex due to that flexibility. So sometimes there's phantom units, sometimes there's what's called profits interest, sometimes there's options like a corporation. There's also sort of in how much equity someone should be granted is often a question that comes up. There are some standard sort of parameters that people see in the industry. People can consult with their legal counsel, with advisors, with consultants, investors, folks involved with the company. There's some surveys out there as well. There's certain for advisors, for independent directors, for certain director level positions, vice VP positions, for various levels. There's kind of very customary bands of the size of the grants. And similarly, there's vesting terms for acceleration of vesting that also can fall into what vary, but also fall into pretty customary bands of what you see. And so companies can work with their advisors to structure what's going to really create the best incentive for their employees and consultants, align interests, and also let them enjoy some of the value when the company is ultimately sold.